I read the news so that you don't have to. You know that safe investment strategy that's been making billionaires even richer? Well, it just turns out they tried to pull 10 billion out of it in a few weeks. So as you can see from the headline, it says that retail investors pull billions from private capital's credit gold mine. So what's really going on? So investors pulling their money out of funds doesn't sound like much of a story. The problem is Blackstone and Apollo Global Management, some of these big firms have basically said, yeah, by the way, you can have your money back, but like not all of it. This is about something called private credit. And if you don't know, briefly, private credit is when instead of banks lending money, you have these big investment firms that lend directly to companies. So think of it like Wall Street becoming a bank. And over the last 5 years, this market, this space has exploded. About $1.5 trillion invested, huge demands from wealthy individuals, and it's supposed to be sold as this like steady income, low risk, low volatility, safe-ish kind of investment. It's the hottest product on Wall Street. So something's happened recently. Investors, especially wealthy individuals, have got really nervous and they're like, we kind of want our money back. The total requests so far have been about $10.1 billion, but here's the problem. These funds, they don't actually hold cash, they hold loans. So firms like BlackRock, Morgan Stanley, Blue Owl Capital, they can't just sell everything overnight. So they've only allowed about 70% of withdrawals. So you thought your money was liquid, it's not. And this is a bit sneaky because these funds make an insane amount of money from firms. For example, Blackstone BCRED's fund alone last year made 1.2 billion in fees. Now here's the trick. They earn the fees based on valuations, not actual sales. So even if nothing gets sold, they still get paid. So the market is now reacting. Investors are like, hold on, we thought this was liquid. It seems not to be as liquid as we thought it was. What's going on? Share prices in firms like KKR and Ares Management, they're down 25%, and over $100 billion has been wiped off of valuations. So here are the implications. The first is the liquidity illusion problem. The key takeaway of this: assets, long-term loans, investors, they want short-term access. That's a mismatch, and that's how cracks start. Think of it as like 2008 vibes, but just with a different asset class. Also shows that retail money is the weak link because these funds shifted from pensions, which is stable money, to wealthy individuals who tend to be kind of emotional, as we've seen. They'll chase returns, but the first sign of danger and they are out the door. And the third implication is that Wall Street's growth engine is at risk. Private credit wasn't just big. It was supposed to be the future growth story, especially targeting the $9 trillion retirement market. If confidence drops, that whole strategy starts to wobble. So if everyone wants their money back at the same time and the assets can't be sold, is this actually an investment or just a queue waiting to panic?